Hi, Mike here. We're going to be talking about one of my favorite subjects, and that is, what am I going to do with all this money that I have found in my budget? Let's say you're in a good situation, you have found an extra $200 or $300, maybe $400 a month, and you wanted to put it somewhere. You might ask yourself, where can I put it? Who can I talk to can tell me the things that will help me do the right things that I want with my money? So if you're in that lucky situation where you actually have some money and you might be questioning where to put it, here's a good example. This is one of my favorite products in all of financial services. In fact, I'll call it the Swiss Army knife for financial service products because it does all kinds of great things. Now, if you're considering where to put your money, you have to consider the different places that most people put their money and some of the positives and negatives that each place has. So if I were to draw 3 traditional places where people put their money, we'll call them nest eggs. Let's see what they are. Let's analyze them. The first place where people put their money is in some kind of bank, right? Whether it's a credit union or it's your local bank, you put it there because that's where most people think that's where my money's going to go. Banks have these things called ATMs where you can actually get money, put money in, and take money out. The fourth place you could put your money, the UTM, under the mattress. For obvious reasons, I don't really recommend putting money in that place. But for the most part, you can put your money in a bank. Now, if you're thinking long term, you might think of some kind of investment, right? Putting it directly into the market, whether that's a stock or a mutual fund or some kind of investment that's directly managed by some professional who can actually buy and sell when you need it. Or if you're an investor that just looks at the market and does your own trading, then of course you want to understand the pros and cons of that. But investment is another place in the market, right? The third place you can put your money is in insurance. Now there's 2 different kinds of insurance. There's term insurance and there's permanent insurance. And for today's discussion, I'm going to talk about permanent insurance and actually what that will do for you. Now if you're going to put your money in one of these 3 nest eggs, you have to understand that there's pluses and there's minuses for each one of them, right? And so we're going to talk about a couple of these pluses and minuses for every single one of these categories. If you put money into a bank, it's relatively easy to get to, right? They call that liquidity. What it means to be liquid is that you have access to your money when you need it. You can go to the ATM, you can go to the bank teller itself, you can write a check, and the money will be able to be exchanged and transferred very easily. Usually within the very second or minute that you want to do that, and there's no time delay on that, right? Another positive of keeping money in a bank is it is safe. In a bank, they have something called the FDIC, the Federal Depository Insurance Corporation, where they guarantee that anything you put in the bank will be protected up to a certain dollar amount. And that is if the bank is robbed, if the bank declares bankruptcy, if there's some kind of run on the bank, they will actually insure your money up to a certain dollar amount. And so it is safe. It's not going to really do a whole bunch of things that'll hurt you if you keep your money in that place. Of course, if you're putting your money in the market, you have some kind of investment. You understand that you want to have a good return on that investment. You want to have growth, right? And so the positive of actually putting money into an investment will be the growth, right? Hopefully you bought some kind of share or some kind of mutual fund where the value will go up over time, and you're going to receive a higher amount of return than the initial money that you put in there. That's called growth. If you're looking at insurance, you want to understand what permanent insurance actually does. Now, the first reason why somebody would get insurance is for protection. Protection of your assets, right? We have insurance on our phones. We have insurance on our vehicles. We have health insurance. We have all kinds of insurance, but life insurance, protecting your very self, your assets, so your family will not be dependent on your income or for other reasons, is a very good reason to put money into some kind of insurance vehicle. Now, with that insurance vehicle, you actually get to have what they call cash value, right? So this is really cash value. And what cash value insurance allows you to do is to build up a nest egg of assets into a place where you have access to them later in life. Now, a positive of that is actually tax benefits. Tax benefits, and we'll get into that in a little bit, but tax benefits are generally a positive reason why you want to have some kind of cash value life insurance. Now, if you look at the negatives, when you put money into a bank, you know that there's no growth. Most banks will give you approximately 0.25% in some kind of a savings account. I know checking accounts don't usually give you any kind of interest. So you're literally just going to be having that money sit there. It is safe, it is liquid, but you're not going to gain anything. So it's not good for long-term savings, right? Because there's no growth on that money. In the investment world, if you're putting money directly into the market, you're hoping for growth, you're hoping for some kind of return, but the opposite of growth is obviously you have risk, you have total loss. You could run into a situation where all the money that you put into that investment tool, that vehicle, that stock, that mutual fund, you could lose everything. And a lot of people have experienced that when they had 401ks and the market dipped down. And if you're approaching retirement and you see that half of your assets, or even worse, maybe all of your assets have just vanished, that you know that there's a risk in the investment world. Of course, the negative to having insurance, a lot of people realize that there is a cost involved for having insurance, right? And generally, depending on what kind of policy you have, you might have a high cost, right? A lot of people, when I talk to them about putting their money into different places, they consider the bank, they consider investment, they don't consider cash value insurance because A, they probably don't understand exactly how that works, or they consider that an expense. There's a cost involved. There's a premium that you have to pay every single month. And usually when things are tight, that's the first thing that people get rid of because they're not looking at as the long-term asset protection, the long-term outcome that you'll actually get with insurance, and the premium is considered a cost. So they get rid of that. What I want to show you today is one of my favorite things in the market, a place where you can actually keep all this really cool stuff, keep all these positives in all three places, and literally get rid of all of the negatives. You can have a vehicle, one place to put your money, where you're actually going to be having liquidity, where you're going to have the safety of principal, where you're actually going to have growth in the investment world, where you're going to actually have protection and tax benefits. Wouldn't you like to know where that is? Well, that's what I'm going to show you today. I'm going to show you one of my very favorite letters are in the English language. I'm going to call that IUL. Now, IUL is a cash value insurance vehicle, okay? In fact, what I'm going to do here is I'm going to build your financial house. Right? Forgive my drawing, but this is a great vehicle. Now, this part right here at a house, obviously that's called a roof. Now, what does a roof do? A roof gives you protection. So the first off, what you need to understand about IUL is that this is an insurance vehicle. In fact, it stands for Indexed Universal Life. That's what IUL stands for. So this is a life insurance vehicle. This is a permanent life insurance vehicle, which means that the moment that you get it, whether you're just a baby or whether you're an adult, you actually will have insurance that's not like term that might run out in 10 years, might run out in 20 years, but this will actually last you your whole life. If you live to age 80, or if you live to age 90, or 100, or even longer than 100, this is a vehicle that, when set up properly, it'll actually give you protection of your assets for your entire life period. So it's a great vehicle to go ahead and do that. Now, here in your financial house, if you're using Indexed Universal Life, you get some great benefits here. A lot of people don't know about the benefits that you actually get, but at the very bottom, and this is true of almost any single permanent life insurance that you'll get, you get tax benefits. Now, the first and most obvious reason where you have tax benefits is when you actually have a beneficiary for life insurance. If you have somebody, whether it's a spouse or there's a family member, maybe a business partner, and you want to actually have them become a beneficiary, if anything were to happen to you, then that death benefit will actually be able to be passed on to whoever your beneficiary is, and that is a tax-free exchange of money. So if you have a $250,000 policy and you want to leave that to your spouse, if anything were to happen to you, you would instantly be able to give her $250,000. Now, when you build a life insurance program, you got to understand that the death benefit is how this whole thing is structured. And so whether that's $250,000, $500,000, $1 million policy, you want to talk to your advisor about how much insurance you actually need. But the death benefit is actually going to be tax-free. Some of the other benefits you actually get with insurance is that you actually have a cash value bucket of money where you're actually going to be growing your assets. And if you take that money out in a certain way, you actually will never be taxed on the proceeds, okay? And so what happens is every single year when you build up that asset, you're going to actually be growing your value in a cash value bucket, and those cash values, depending on how it's structured, will be able to be available to you on a tax-free basis. You can pull out money for your retirement. You can pull out money for paying off your mortgage. You can pull out money for buying that car you want to. You can pull out money out to actually send people to college, your children to college. You can use that money, and unlike your traditional retirement vehicle where you have to be 59 and a half, you actually don't have to have any age requirements. You can pull this out tax-free at any age for literally any reason you want. And it's a great vehicle for that purpose. Now, the way you pull that out is, of course, you can pull out your cost basis. In other words, the money that you put into that program will actually be pulled out tax-free. And this is done because it's an after-tax vehicle. You paid your income taxes, and whatever extra money that you have to put in this vehicle, you've already paid taxes on it. And so it is after tax, much like a Roth vehicle might be. It is after taxes. And so the money that you put in will actually be available to you and never pay taxes again if you do that when you withdraw the policy. Eventually what's going to happen is that your cash value bucket will start to grow, and it might exceed your bucket of money that you put in there on your cost basis. And so we can talk about that in a second. But the interest, the growth that you get in that, if you take that out in the form of a loan, you will never be taxed either. So that's how you can supplement your retirement, and you can pay out things like your debts and your mortgages, and that's one of the benefits of actually having an insurance type vehicle. So you get tax benefits. Now, what's interesting about IUL is it actually has some great benefits, and it gives you growth. It actually literally has money in a cash value that is put inside a bucket, which is run as a separate account, and it actually is tied to what we call an index. Okay, in fact, an index like the S&P 500, like the Dow Jones, like the Hang Seng in China, or like the Euro stocks in Europe, is a collaboration or collection of a whole bunch of stocks, a whole bunch of mutual funds, and it's actually, they're valued based on certain parameters. For example, the Standard & Poor's 500 are the 500 largest companies in the United States based on capitalization. And so if you understand the S&P 500, you can look at the news and you always see that being listed, whether it's going up or whether it's going down. And so in an index type of vehicle, you actually can put money that's going to grow based on the performance of an index. Okay, and so we're going to put that up here. We're going to put the S&P 500, for example, and we'll come back to later. Now, the benefit of actually having an index universal life product is that they give you growth, as we mentioned, based on the S&P 500 or based on some other kind of index. And lots of different companies have different types of indexes that they use, different strategies they use. Okay, and as the market goes up, your money goes up. And generally speaking, they'll give you about a 12 to 15% cap on that index. What they do is they give you a participation rate, or they give you some kind of cap where they say when the market goes up and approaches 12 to 15%, we'll credit you based on that performance. However, if it goes higher than 12%, a lot of times they'll just cut off the top, and you won't get that credit rated to your account. But on the bottom end, they actually give you a 0% floor. Okay, again, depending on the contract you have, but this is contractually guaranteed to, when the market goes up, your money will goes up. When the market goes down, you actually have a 0% interest rate. So you literally have growth and no loss. Somewhere your money is going to be in between 0% and 12-15%. I like to tell people that when you're putting your money into an investment, your money is riding the waves of the ocean. Right? The market go up, the market go down, the market go up, the market go down, and maybe your financial professional might have some indicators, might have some ideas about when that market's going to go up and go down, but he doesn't have a crystal ball. He doesn't know exactly what's going to happen. And one thing that's true is that the performance of the market is always going to be volatile to some degree. It's going to go up, it's going to go down. And so that's like putting your money into a boat that's just riding the waves of the ocean. My daughter likes riding the escalator. where literally you go in one direction and it's going one way. Again, the way this vehicle works is that the money is actually going to be growing. It's going to be hitting the performance of the market up to that cap, and if the market were to go down, you would not lose anything. So in other words, if in 1 year the market went up 15%, your vehicle might allow you to capture 15%. If in year 2 the market went down 12%, you're not getting a 12% loss in your money. You're actually going to be getting a 0% floor. And so it's perfect for growth and no loss. The third story, we talked a little bit about indexes, right? You want to have hindsight. You want to understand that hindsight is 20/20. One of the things about investments we talked about is how it is waves of the ocean, right? And when you actually are invested in the market, you're speculating. You're hoping that you get a good rate of return. You're hoping that if you buy this share of stock, if you're buying some kind of mutual funds, that the manager that you're paying will be aware of the indicators in the market and be able to buy in or sell your shares according to his ideas, according to his strategy, and where you have your money. The way this actually works is hindsight is 20/20. You're literally getting credited for what the S&P 500 did or some other index actually did at the end of the year, at the end of the segment where that actual money is going to be looked at, and they're not speculating anything. They're going to give you a mathematical equation saying, okay, well, the market did this much percentage, we're going to credit you that much percentage. So that's what an IUL is. It literally is a life insurance vehicle that you can have for your entire life, and hopefully that'll be a long time, where you put money into it where now you have a death benefit to give to any beneficiaries. You can put money into a separate account that'll grow according to performance of some kind of index. There are products that have global indexes, so you might have the Hang Seng China, or you might have the Euro stocks because they are globally credited. And as your money goes up, it goes according to the performance of that index, and it's going to be moving in one direction. It'll never go back down, but it's only going to be moving up. And when you put that money in, the cash value will actually be growing. It'll be growing into a position where the performance will do what you need it to do. And when you need to take that money out, there's any age for any reason. So again, you don't have to wait till you're 59 and a half. You've already paid taxes on the cost basis, and the growth is actually taken out in the form of a loan against your cash value. So if you have $560,000 in your death benefit, and let's say you wanted to borrow $100,000 to pay off your mortgage, you literally can borrow $100,000 from that vehicle, which gives you a remaining balance of $460,000. Okay, so basically how it gets paid for is you will actually have a premium every single month. Most of the time you want to pay your premiums on a monthly basis, and it gets divided very easily. So you have a monthly amount. Let's say that you have $100 a month going into this thing. That might not be the best place to put $100 a month, but if you have more, 200, 300, whatever that might be, that'll be into your monthly premium, right? Again, depending on your situation, and if you have a good planner to tell you how to do that, what's going to happen is your money's going to go to two basic places. The first base will just basically be for the insurance itself, and the second place it'll go will be for the investment with all those cool things we talked about. Now again, this is based on the amount of insurance you have. It's also, because that is a life insurance product, it's going to be based on your age, it's going to be based on your health, it's going to be based on whether you're male or female, and every case is going to be a little bit different. But for the most part, you're looking at about 15 to 30% of your monthly premium is going to be covering the cost of insurance, okay? Which means that about 70 to 85% of your monthly premium is going to be going into a vehicle that gives you all those great benefits. And that is how an IUL works. I advise you to talk to your insurance professional, ask them what an IUL is, what it can do for you. I personally believe that they're great vehicles. Not everybody is going to be qualified to get one, but they certainly are, like I said, financial Swiss Army knife, because they do so many great things. Thanks.